Imagine trying to coordinate shipping high-tech polymers all over the entire globe, right? You're trying to fulfill these multi-million-dollar industrial contracts on time.
Right.
But at the exact same time, your own sales team is literally sheltering from air raid sirens in Dubai.
Yeah, it's intense.
It is. So today we're looking at the Q2 2026 earnings of a mid-sized specialty chemical company, just to show you, the listener, exactly how the global economy is functioning right now, like in real time, inside an actual war zone.
Which is wild to think about.
Completely. So welcome to another deep dive. We are super thrilled to have you with us today. Our source material today revolves around Northern Technologies International, or NTI.
That's right.
We've poured over their Q2 earnings report, the conference call transcript, and their Form 10Q SEC filing. And if you aren't familiar with the 10Q, it's basically this mandated, highly detailed financial MRI.
It really is.
Yeah, publicly traded companies have to submit it every quarter, and it totally strips away the marketing spin to show you the raw, actual health of the business.
And, looking at this specific company's financial MRI, it just offers this remarkable window into the broader corporate world right now. I mean, NTIC is definitely not a household name, right?
Right.
But their operations represent a complete microcosm of modern corporate survival. They operate in these two completely opposite spheres.
Yeah, totally different worlds.
Exactly. On one side, they are managing rust for heavy industries, and on the other, they're developing compostable plastics for the green transition.
Right.
So by dissecting their current quarter, we can see the literal nuts and bolts of how a business absorbs massive supply chain shocks, how they navigate shifting trade tariffs, and how they manage really volatile geopolitics.
Okay, let's unpack this, because if you really want to understand the state of global manufacturing, you need to think of NTIC as the ultimate canary in the global supply chain coal mine.
Oh, I like that analogy.
Thanks. It's like they are so deeply embedded in so many different sectors and regions that whatever happens in the world, a closed shipping lane, a random spike in raw material costs, or new environmental regulations in Asia, it registers immediately on their balance sheet.
It does. And understand how they absorb those shocks without just completely collapsing, we first have to look past the raw numbers. We need to look at their financial bedrock.
Right, the core business.
Exactly. We have to examine the core mechanism of how they actually generate their primary revenue.
Right.
Because that diversity in their product and geography acts as a shield against all this global volatility.
And that bedrock is essentially, well, it's a war on rust.
Yes, literally.
They call this primary segment Zerust. And looking at the Q2 numbers, this core engine is just firing on all cylinders right now. I mean, their consolidated net sales for the quarter rose 15.3% to $22.0 million.
That's a solid jump.
Yeah. And out of that 22 million, almost 75%, 74.9 to be exact, comes straight from Zerust. But I gotta say, when I first read through the materials and saw the phrase volatile corrosion inhibitor films, my very first thought was, okay, this sounds highly explosive.
Right, it sounds terrifying.
Yeah. Like, what actually is a volatile corrosion inhibitor, and why is heavy industry buying like $16 million worth of it in a single quarter?
So it does sound dangerous, but volatile in this context just refers to how the chemical compounds actually behave.
Okay.
Think about the old way of doing things. Instead of painting this thick, messy layer of grease onto a metal pipe to stop it from rusting, NTIC manufactures specialized plastic packaging, like films or powders.
Like heavy-duty plastic wrap.
Essentially, yeah. But it's infused with these specific chemical compounds. And when a metal part is enclosed in this packaging, the chemicals vaporize. They become a gas.
Wait, really? A gas?
Yeah. It disperses and actually settles onto the surface of the metal, forming this microscopic protective molecular layer. It acts as a literal physical barrier against oxygen and moisture. And the best part is, when you take the part out of the packaging, the vapor just dissipates into the air.
So no cleaning required.
Exactly. The metal is perfectly clean and ready to use without needing to be degreased or scrubbed down.
That is just brilliant. It's like selling umbrellas in a perpetual rainstorm.
Yeah.
I mean, you are essentially creating a localized, rust-proof atmosphere for the equipment. And it makes total sense why demand for that specific tech is surging right now, especially in their oil and gas division.
Oh, absolutely.
The sources highlight that the Zerust Oil and Gas segment just posted a record quarter. Sales were up 72.1% year over year.
Which is a massive number. And the anchor of that 72% growth is a highly specific contract they detailed on the earnings call. They secured this 3-year offshore contract in Brazil, worth an estimated $13 million.
That's huge.
Right, and it's ramping up right now, starting in 2026 and running through 2028.
I mean, winning a $13 million contract is a massive headline, obviously, but to me, the real story is the infrastructure required to actually execute it, you know? You don't just, like, mail a cardboard box of plastic film to a deepwater oil rig.
No, you definitely don't. And what's fascinating here is the broader industry validation this provides.
How so?
Well, Brazil is currently one of the fastest-growing deepwater extraction markets on the planet. These companies are out there operating multi-billion-dollar offshore rigs in some of the most highly corrosive saltwater environments imaginable.
Saltwater is brutal on metal.
Exactly. So winning this bid means NTIC's engineering capabilities have been rigorously vetted by some of the most demanding operators in the entire world.
Ah,
It signals to other global energy companies that NTIC isn't just a basic material supplier, you know? They are a highly scalable engineering partner capable of designing bespoke corrosion ecosystems for these massive offshore projects.
Here's where it gets really interesting, though, because the very same global footprint that allows them to win those deepwater contracts in South America is currently dragging them into literal warfare in the Middle East.
Right.
They recently opened a new subsidiary in Dubai. It's called ZIS UAE to capture the surging oil and gas demand in that region. But their business strategy is now colliding head-on with geopolitical conflict.
Yeah, the earnings transcript provides a really sobering look at the operational reality on the ground over there. The CFO explicitly stated that their employees in Dubai are dealing with air raid sirens and lockdowns firsthand.
Right, and we should definitely note for you listening that the sources and, well, our discussion today are focused entirely on the operational and economic realities of the situation.
Yes, completely impartial.
Exactly. Without taking any political stance, we're just looking at the business facts. And purely from a business perspective, the numbers coming out of that region are staggering.
They are.
The CFO noted that despite the conflict, their non-Brazil oil and gas sales, which are heavily driven by this exact Middle East expansion, still grew by roughly 85% year over year.
Which is almost hard to believe.
Right. I have to admit genuine confusion here. If, missiles are flying and the Red Sea shipping lanes are heavily compromised, how does physical product actually reach the clients?
It's a logistical nightmare.
You can't just wish these materials across borders. Isn't the risk of a regional supply chain collapse just way too high?
Well, the analyst on the earnings call honed in on that exact vulnerability.
Yeah.
And the survival mechanism NTIC relies on is supply chain decentralization.
Okay, meaning what exactly?
Management emphasized that they are not sole-sourced in any single geographic area. They don't just rely on one mega factory in one country to produce all their volatile corrosion inhibitors.
So they have like a web of regional facilities.
Exactly. So if a shipment bound for a massive client in Brazil is suddenly blocked because container ships can't safely navigate those Middle East corridors, NTIC isn't just paralyzed. They can essentially ping their global network and reroute the production order to a joint venture in Europe or Asia to fulfill that South American demand.
Wow. Okay, so that agility is what keeps the revenue flowing.
Right.
However, routing around a war zone doesn't actually solve the macroeconomic fallout of the conflict. I mean, the disruption in the Middle East creates a direct causal chain that hits NTIC's bottom line.
Oh, absolutely.
Regional instability causes global energy prices to spike. When crude oil prices spike, the cost of petroleum byproducts skyrockets. And the foundational raw material NTIC uses to manufacture those Zerust protective films is polyethylene, which is a direct petroleum derivative.
Exactly. So even if they successfully reroute the manufacturing, the actual plastic they're using is suddenly much, much more expensive.
Which immediately compresses their profit margins.
And this is where we see a really significant evolution in their management strategy.
How so?
During previous global shocks, like the COVID-19 pandemic, management admitted they reacted way too slowly to rising raw material costs, and they absorbed heavy margin losses as a result.
Yeah, that was a tough time for a lot of supply chains.
But today, they are attacking the problem proactively with data. They're going directly to their heavy industry customers, opening their books and mapping out the exact global math.
Show your work, basically.
Yes, they show the customer the direct line from the Middle East conflict to the rising cost of crude to the spiking cost of polyethylene resin.
Oh, that's smart. They are essentially proving the math so the customer understands exactly why the price of the Zerust product has to go up.
Right.
And because those heavy industry customers are directly tied to the oil markets themselves, they intimately understand that macroeconomic chain. It makes a price hike feel logical rather than, predatory.
Exactly. That transparency builds trust, and more importantly, it protects NTIC's margins in real time, rather than just sort of hoping costs eventually come down.
The incredible irony of this entire earnings report is that the revenue NTIC generates by protecting heavy machinery for the petroleum industry is literally being used to fund a division that wants to replace petroleum entirely.
It is a pretty wild paradox.
Right. While Zerust manages the harsh realities of heavy oil extraction, their other division, Natur-Tec, is completely focused on developing fully biodegradable plant-based plastics.
Yeah, Natur-Tec is a completely distinct scientific and economic endeavor from the rust prevention side, but it's rapidly becoming a foundational pillar of their whole business structure.
And the 10Q numbers definitely confirm that. I mean, Natur-Tec accounted for 25.1% of their total consolidated sales this quarter, and it grew 8.1% year over year to $5.4 million. But looking at the margins, this green transition looks financially painful. The direct cost of goods sold for Natur-Tec sits at nearly 70%.
Which is high.
Yeah, if we compare that to the Zerust side, which costs about 58% to produce, that is a massive disparity in profitability. Is plant starch simply that much more intrinsically expensive to process than crude oil derivatives, or is this like a structural supply chain issue?
Well, it's really a combination of both raw material economics and bruising global trade dynamics. On the macro level, the market for generic eco-friendly plastics is intensely competitive. NTIC is selling to customers who operate on razor-thin margins themselves, like food service distributors, which forces NTIC to lower their own prices just to win bids.
Right. A race to the bottom.
But the secondary, much more volatile factor driving that 70% cost is global tariffs. To avoid crippling import taxes, NTIC has had to repeatedly shift their Natur-Tec manufacturing footprints between facilities in China, Vietnam, and India.
Just constantly moving.
Yes, and moving industrial molds, securing new raw material suppliers, and reestablishing quality control in a new country every single time trade policy changes. It is incredibly capital intensive.
So wait, if the generic compostable plastics market forces you into a race to the bottom on price, and the manufacturing lines are hyper-vulnerable to shifting trade wars, why bother?
It's a fair question.
From a purely capitalistic standpoint, why endure a 70% cost of goods sold? Are they just trying to boost their ESG scores with an eco-friendly side project?
If we connect this to the bigger picture, NTIC's strategy here is actually a highly calculated long game.
Okay.
They recognize that fighting over generic, high-volume compostable bags is a low-margin trap. The only way to survive the tariffs and the competition is to completely change what you are selling.
Right.
You have to move up the value chain by engineering proprietary high-tech resins that your competitors simply cannot replicate.
And the CEO teased exactly what that looks like on the earnings call. He mentioned they are developing a new compostable food packaging solution that resists moisture.
Yes.
And they expect that to hit the market in the next 6 to 12 months.
And that specific technological breakthrough is basically the holy grail of bioplastics.
Really? Why is moisture such a big deal?
Because the fundamental tension in designing a compostable plastic is that you are trying to create a polymer chain strong enough to hold wet food like, think of a warm sandwich or a salad.
Right.
But it has to be weak enough that it completely breaks down when exposed to the moisture of a commercial compost facility.
Oh, wow. That is a tricky balance.
Historically, moisture compromises bioplastics almost immediately, just turning them completely soggy.
Nobody wants a soggy container for their lunch.
Exactly.
So if NTIC actually cracks the underlying molecular chemistry to create a moisture barrier bioplastic that still degrades on command, they completely sidestep the generic price war.
Exactly.
They own a proprietary solution to a massive industry headache, meaning they dictate the pricing, which drastically improves those painful 70% margins down the road.
The strategy is super sound, but pioneering proprietary bioplastic resins while simultaneously financing a massive global oil and gas expansion requires immense amounts of capital.
Yeah, that does not come cheap.
We have to look at the financial reality of executing this dual-pronged approach.
So what does this all mean for the bottom line today? When you look at the 10Q, the financial reality check is severe.
It is.
Despite hitting that record $22 million in revenue, NTIC actually reported a net loss of $35,000 for the quarter. They missed their earnings per share expectations. Furthermore, their overall liquidity has noticeably weakened. Their cash on hand dwindled down to $5.6 million, and their total debt climbed to $14.3 million.
That's a big jump in debt.
And $11.3 million of that debt is actively drawn from a $12 million revolving line of credit with JP Morgan. So they are brushing right up against their credit ceiling.
Yeah, they really are. But the primary driver behind that net loss is a 7.7% jump in operating expenses, which hit $9.5 million for the quarter.
Okay.
But a deeper read of the 10Q reveals the mechanism behind that cash drain. This isn't bloated administrative waste. It is heavy capital expenditure designed to build future capacity.
What are they spending it on?
They spent massive amounts to hire and position those specialized global sales teams in places like Brazil and the Middle East. They also spent over $4 million just to purchase and upgrade a building adjacent to their headquarters.
And the purpose of buying that building directly ties back to the Natur-Tec margin problem we just discussed.
Right.
They bought it to bring more of that bioplastic manufacturing in-house rather than paying tolls to third-party manufacturers across Asia.
Exactly. Furthermore, they executed a global SAP software implementation.
Oh, man, SAP.
Right. For anyone who hasn't lived through one, an SAP implementation involves tearing out a company's old fragmented data systems and installing a unified enterprise resource planning system.
It's a total nightmare.
It connects inventory, supply chain, and financial data globally. And the CFO openly admitted the process has been painful and highly disruptive.
I mean, I look at NTIC's balance sheet right now, and the best way to conceptualize it is to think of a massive structural home renovation.
That is a perfect way to look at it.
Your bank account looks absolutely horrific while you are paying the general contractors, and you're just living in the dust and chaos of installing all new plumbing, which is essentially what that painful SAP system is.
Right.
But the SAP system is the smart plumbing that actually allows them to see a shipping blockage in the Red Sea and instantly reroute their raw materials to India. The renovation is miserable, but the structural value and capability of the house are fundamentally increasing.
The management team shares that exact sentiment. They stated on the call that NTIC is officially moving out of the investment phase and transitioning into the execution phase.
So the heavy lifting is done.
Mostly, yeah. The heaviest cash-draining projects like the building purchase, the disruptive software integration, the initial global hiring surges, those are now largely in the rearview mirror.
Nice.
Because that foundational capacity is built, they anticipate revenue growth will consistently outpace operating expenses in the second half of 2026.
Which means operating leverage finally kicks in. If you hold your newly established expenses flat while your sales continue to climb, a much larger percentage of every new dollar flows directly into pure profit.
Exactly.
And they desperately need that cash flow to aggressively pay down that $14.3 million JP Morgan debt.
Right. And beyond their own cash flow, they are also relying on their complex network of global joint ventures.
Oh, right, the JVs.
A significant portion of NTIC's operating capital, historically, comes from dividends paid out by their JV partners, particularly those based in Europe.
But the European industrial markets have been incredibly sluggish recently, which has definitely suppressed those dividend checks.
True. But management noted that as massive government stimulus packages begin taking effect across Europe, specifically aimed at revitalizing German manufacturing, they expect those European JVs to recover.
Okay, that makes sense.
So as those operations scale back up, the vital dividend payments flowing back to NTIC will increase, providing another lever to pay down that credit line.
There is also one crucial quirk buried in the 10Q that really skews how bad this quarter looks on paper.
Yes, the anomaly.
Right. When you compare this year's net loss to last year's Q2 profit, you have to account for a massive government anomaly.
So last year, in Q2 of 2025, NTIC received a one-time cash injection of $1.1 million from the United States government.
Which is huge for a company this size.
It was through the Employee Retention Credit, or ERC.
Yeah, they essentially had a $1 million government windfall artificially padding their profitability last year.
Exactly.
Because that anomaly didn't repeat this year, the year-over-year comparison looks artificially steep. When you strip away that one-time ERC payment, the core operational growth of the actual business this year is significantly stronger than the headline net loss suggests.
Right. Analyzing the raw data without the context of that $1.1 million credit leads to a fundamentally flawed understanding of their current trajectory.
So, bringing all these complex threads together for you listening, why does understanding a mid-sized chemical company's quarterly report actually matter?
It's a great question.
Whether you manage your own operations, invest in equities, or you simply want to understand the invisible forces shaping the modern world, NTIC provides this flawless blueprint of modern corporate agility.
It really does.
To thrive in 2026, a business cannot afford to be monolithic. You have to simultaneously manage the localized fallout of Middle Eastern conflicts, capitalize on the deep water engineering demands of Brazil, pioneer molecular breakthroughs in compostable food packaging, and actively reroute global supply chains around shifting trade tariffs.
All at once.
You have to balance all of those conflicting realities at the exact same time while systematically upgrading your internal data software without running out of cash.
It requires an astonishing level of operational elasticity.
Yeah.
And, looking at how NTIC straddles these two vastly different worlds leaves me with one really important lingering question.
What's that?
We consistently talk about the green energy transition as being championed by pure-play Silicon Valley clean tech startups fueled by venture capital.
Sure, the usual suspects.
But if a traditional legacy chemical company, a business whose entire financial bedrock relies on protecting heavy petroleum extraction equipment, can successfully pioneer proprietary water-resistant bioplastics, does the actual future of corporate sustainability belong to these quote-unquote dirty industries?
Wow.
Perhaps these deeply embedded industrial players are the ones quietly funding the green revolution from the inside, leveraging the massive profits of the old carbon economy to engineer the sustainable materials of the new one.
The old world quietly bankrolling the new. That is a brilliant framework to view the global economy through. Thank you so much for joining us for this deep dive. Keep examining the sources, look for the hidden causal chains driving the headlines, and we will see you next time.